the part 6 on the funds transfer pricing process. Today, I would like to walk you through the liquidity transfer pricing, or better known as LTP. So LTP deals with the liquidity component of the funds transfer pricing process. So how to charge it out, how to remunerate the business unit for the funding, and also deals with the contingent liquidity cost, which we mentioned briefly in the previous parts, which is due to the liquidity which has to be stored or accumulated in the form of liquid asset buffer, because some products give rise to the need of holding HQLA, so high quality liquid asset buffer. As such, there are methodologies of allocation of this cost to the business unit, both because, of course, this cost could be or benefit or cost. It depends on the cost of carry, and I will come back to this point. However, important to highlight at this point, we have two parts of LTP process. First one is the allocation or FTP'd the product from the liquidity perspective, which is allocating the correct TLP, term liquidity premium, or remunerate the appropriate term liquidity premium to the liability center because of the quality or stickiness of the funding which the business unit has provided the bank with. And the second one is call, I will call it in this sessions, call contingent liquidity cost or cost of liquidity, which I am referring to in this particular example for the need of holding a liquid asset buffer, so HQLA. And, in some cases, we can have negative cost of carry, which means that the funding of HQLA is higher than the return which we are getting from HQLA. And this is known under the term of negative cost of carry. And this is where we need to allocate this cost out from the LM or treasury, because they are holding the HQLA because of the other products. As you know, there are products which are like financial institution, deposit from financial institution, which under LCR, liquidity coverage ratio, is getting 100% of outflows. As such, it means that you need to hold against this product. If this product falls in the 30-day of LCR window, you need to hold 100% of HQLA. Now, at this point, I don't want to dwell too much in detail because it's really a bit more than 100, because usually the banks have the buffer on the regulatory requirements for LCR. But in this particular point, what I'm trying to do is to, to show you what kind of liquidity, contingent liquidity, what exactly where it sits in terms of the liquidity management framework. And this is exactly what we have, this, contingency liquidity, which could drive the negative cost of carry. Today, we have just the other way around, but not for all products. But usually, when the rates are very high, nowadays, we have positive cost of carry, because the remuneration on the HQLA is higher than the cost of funding HQLA. And therefore, we are saying about the positive cost of carry, which needs to be benefited to the business units as well, because it's not okay if you charge when it's negative, but you hold the benefit when it's positive. So our ILM should be, treasury should be benefit, passing this benefit to the business units because of the positive cost of carry. But let's go into details. And today I would like to show you the methodology how to calculate this contingent liquidity cost and how to allocate it to the certain product. And I will show you in this not this video probably, but the next one, I will show you the methodology of incorporating this cost in the curve construct. So FTP curve construct, because this cost could be allocated on the separate basis. So you are allocating your FTP as per normal process. Then at some point you have to charge also the cost of liquid asset buffer, and this is done once a month. It depends on the practice, but once a month you are charging this. You are calculating, finance department is calculating this cost and is allocating to the business units. So it is not included in the FTP rate. Meanwhile, under the second approach, which I'm going to show you next time, we are talking about behavioralization in the FTP process. So we will be passing this cost through the FTP curve. So let's start from the beginning. Let's talk about, first of all, concept or best practices of the liquidity transfer pricing. These are quite common, covered in, well covered, not common, but well covered in the regulatory guidelines. Regulator is explicitly referring to the liquid asset buffer cost when it talks about FTP, and providing us with this best practices or guidelines how it should be approached by the bank. So first of all, there is clear need of explicitity, simplicity, transparency, so that every stakeholder in the FTP process should know how the LTP is calculated. So it shouldn't be a black box exercise when no one knows how Treasury or LM is setting up those methodologies, but it should be socialized to the stakeholders in the meetings, and it should be everyone should be aware of any changes which are clearly communicated to the business unit. The second one is senior management should be able to identify the users of liquidity and the nature of liquidity in terms of volume and tenor. This is very interesting point, because this is why we have TLP by tenor. So you have the FTP curve. FTP curve includes the TLP component by tenor. So each tenor has its own allocated TLP component. And the reason why we are dividing it by tenors, of course, because the bank has its own possibility of gathering funding in the external market, albeit the deposit funding, albeit the wholesale funding. However, there is availability of certain volumes in the market, and not all volumes are readily available. So, for example, in UK market, in deposit market, you have clear appetite for depositors to invest in the 1 year FTD. However, there is no appetite to invest in 5 year FTD. Therefore, for the bank to get significant volumes in 5 year FTD, it would be almost impossible unless, I don't know, you set up the price, which is absolutely outlier in order to get those volumes. But we know that usually the banks are trying to stay close to each other in order not to drive the deposit price too much. So in this case, when there are available volumes, you will see that this particular, tenor in terms of the TLP will be showing you this appetite. It it could be, with the quite higher, because you are competitive, you want to gather those volumes. So in this situation, you are able to know what is the particular tenor for your bank, which is attractive for your balance sheet, which is available in the market, which is sufficiently available in the external market to fund your balance sheet. So there are volumes in these tenors. So through the TLP, you have awareness of availability of certain volumes and tenors. Again, this is exactly the point number 3, which I've already covered. The price of liquidity should reflect the availability of required volumes and tenors. Exactly. So this is how you calibrate, you gauge your tenors, your cost of deposit or wholesale funding by tenor, because it reflects your appetite, your own bank appetite for those tenors. Better LTP practices require that banks define an LTP policy which set forth principles or rules to ensure LTP process is fit for purpose. And again, regulator is requiring to have the separate chapter on LTP in your ILAP. So ILAP is the one of the most important documents from the liquidity standpoint for the banks, because it is done at least annually on the annual basis, where unless a regulator requires more frequent update or there is some problem, normally it is once a year. And Treasury is in this document is basically the whole process. It's not only the document, but this is documented process of how good, how robust is your liquidity management in the bank. This is why it is called individual liquidity adequacy assessment process. So ILAP, because it is telling to the regulator how robust is your liquidity management process within the bank. And regulator is setting up the best practice for writing the ILAP, for approaching the ILAP exercise. And there is a chapter which is dedicated, which is supposed to be fully dedicated to LTP process. So again, this is very important to know what are these liquidity transfer pricing best practices. Bank should charge term premium rates on the marginal cost of funds. Okay, so this is again important point, which I already anticipate here, but will be covered very well during the FTP curve construct. FTP is working on the marginality basis. So the central FTP model, which we are discussing here in this presentation, is working on the marginality approach, which means you are answering the question through this marginal cost of funds. How much I have to pay for additional funding to fund 1 unit of your new assets. So what is this additional marginal rate of the new funding which you have to gather in order to expand your balance sheet? This is it's not average cost of funds, it is telling you about marginal cost of funds. And this is quite important concept in FTP and the central model, because you have some methods which are working on the average cost of funds. We will mention them. However, here we are referring to the central model. When we have the ILM in center, we have the business units like we shown in the first episode, number 1 and 2, where how this principal model works. So there is this exchange passing the risk to the central unit. And again, this is all based on the curve, FTP curve. But FTP curve is constructed from the base component, which reflects the cost of hedging for treasury, and TLP, which is a term liquidity premium by each tenor, which reflects the marginal cost of funds for this particular tenor to get to fund your balance sheet. So important point. Term liquidity should be applied also to floating rate instruments. Many institutions inappropriately assign short-term cost of funds to floating rate products. So, okay, when we have two products, imagine you have two products. One is the fixed rate asset with the repricing period of 5 years and maturity of 5 years. It is fixed rate asset bullet. Your FTP will be the summation of base rate, swap rate for 5-year tenor, plus 5-year TLP. Because it's, as I said, 5-year repricing, 5-year maturing product. But imagine the same 5-year maturing product, however, repricing overnight. So, of course, this product won't be FTP'd only on the overnight time bucket, overnight rate. Time bucket, I mean, from the allocation perspective, overnight rate. Because yes, it reprices on the overnight frequency. So you will be charging the overnight rate to this particular product. However, there is the TLP component, which is for 5 years, because this product consumes liquidity for 5 years, not overnight. So in this particular case, the FTP, overall FTP rate for the product will be a summation of overnight base reference rate plus TLP for 5 years. And in some cases, I notice that the bank and regulator also notice it. This product is not properly FTP'd because the TLP, correct TLP, is missing. So always answer the question for how long the product is consuming liquidity. And this will provide you with the answer what should be the TLP allocated to this product. So one thing is the interest rate risk component, another one is TLP. Business activities creating a need for additional liquidity, here we are talking about contingency liquidity, should be charged on their expected usage of contingency liquidity. As we've just said, there is a cost, could be a benefit. Today we see the benefits because the HQLA mainly is the cost of running HQLA is positive. So we are earning money on HQLA, but in the lower rate environment, this is not the case. It is negative drag to P&L. So ILM shouldn't be holding this cost centrally. This cost should be charged out to the business on a separate basis. And there are different methodologies, as I said. Let's talk about first methodology of charging it on the separate basis. So finance will come up with the cost of HQLA on the monthly basis and will be charging it to the business which consumes contingency liquidity. Okay, let's analyze. Let's first, in order to understand what to charge, I need to first quantify this charge. So one thing is how to charge, how much, but then what exactly is this call? Let's call it here, which is cost of liquidity, which should be charged for contingent liquidity. Let's start off from the beginning. Ensuring sufficient liquidity in a stress scenario is a vital requirement for institution. Of course, please remember that this is the liquidity which is covering the liquidity under stress. I'm about to publish the course on the liquidity risk management on my learning platform. So it will be available within a few days. So if you are interested in the liquidity management framework, stress test scenario, ILAP, and metrics for liquidity, feel free to to have a look and to go through it. So maintaining a liquidity reserve has a cost which should be allocated to the source of liquidity risk. Again, it is not always the cost. In some situation, it could be a benefit, like now. Holding such assets imposes additional cost on institutions. The definition of both composition and size of liquidity reserve is a key task for ILM unit. Exactly. Treasury ILM is responsible on the top of management of the interest rate risk. Robust liquidity management is also responsible of management this contingency liquidity. So to quantify how much it should be, and also what is the structure of liquid asset buffer, because it could be, quite significant because you have a risky profile of your balance sheet, or it could be less significant, and it is it's all based on your survival horizon. Survival horizon, again, I'm referring to the metrics which I'm describing in the liquidity management course, is key metrics under stress for the bank to size this amount of HQLA. And effective way to accomplish this, cost of running the liquid asset buffer, the potential cost, is through the funds transfer pricing or liquidity transfer pricing. And how we calculate, or how we define the call, it is the difference between the cost of funding of liquid asset buffer and the remuneration which you have on the liquid asset buffer. Okay, so of course, if the cost is higher, you have the negative number, because the cost of funding is higher than the remuneration, and we are calling it negative cost of carry. When it's positive, because the remuneration of the liquid asset buffer is higher than the cost of funding them, we are talking about positive cost of carry. And this is the equation exactly which you see here. Now, how to charge it out? Of course, it's not always, every bank has its own process. What I'm going to show you here is one of the potential methodologies, which I have seen in the past, which was used to allocate the cost to assets and liabilities, because it will be splitting the cost between assets and liabilities. So what I'm going to show you in starting immediately in the next video is the example of allocation of contingency liquidity to short-term asset and liabilities. Short-term, because all of assets and liabilities which are falling within the window of short-term metric, which could be based on the LCR, so liquidity coverage ratio, regulatory metric, or should be based on your own internal metric for stress test, which could be survival horizon. It is up to the bank to decide which metrics is the driver in the allocation of contingency liquidity cost for the bank. For today, it's sufficient. I will cover the example shown here in the slide during the next session, and we will be discussing it both for the asset and for liabilities. Thank you. Have a lovely day.